Welcome back, traders and investors. We have Jackie Matthews on the line here, and she's the founder of and CEO of PJMINT. She's worked at Goldman Sachs as a managing partner and CEO for her quantitative hedge fund, now PJM Capital. Jackie, give us a little bit of your background and tell us how you're doing this morning.
Good morning, everyone. Good morning, Benzinga. It's been great. I think you covered a little bit of my background. I started at Goldman Sachs on Wall Street. Actually worked for Robert Rubin when he was co-chair before going to the White House and becoming U.S. Treasury Secretary. I then moved more into the wealth management for ultra-high net worth families in their investment family offices, including working for current U.S. Senator of Virginia, Mark Warner, in his $200 million family office, and then moved into the hedge fund world and managing a quantitative hedge fund, global macro hedge fund, was chief operating officer, and then before founding PJMINT. PJMINT is something that's a little bit different from our background in the institutional space. Our mission is really trying to democratize advanced quantitative investment management solutions to either individual DIY investors or also providing a platform for other wealth planners who either are considering setting up their own shop as entrepreneurs or within their current infrastructure.
And how much are you managing now?
That's not something that we can disclose,
Okay.
but we just launched we've been really working for other wealth planners, and then we just launched our website actually in late November that was open to individual investors. And so we had a nice, sort of coverage in Barron's in January and Wall Street Journal. And so we're off to a great start. It's been a great positive response.
So what did you do at Goldman Sachs?
I was in investment banking actually. Really trying to, I was actually started in New York and then went over to Asia and was really part of that movement of going into the China market and also in Taiwan, helping to open up their offices there, and was really into privatization and bringing a lot of the government companies into the international IPO space.
Okay, so you wanted to talk about traditional passive buy and hold approach on a standalone basis that many wealth planners and people employ, and you think that strategy's flawed. You want to talk about that topic?
Yeah, sure. So one of the sort of catalysts or inspirations for me to found PJMINT was really after 2008. A lot of our friends were really hit badly by the financial crisis, and some of them were doing investing on their own. Others had wealth planners, but nevertheless, even if they did have wealth planners, a lot of them were in sort of the traditional passive buy and hold, 60-40 passive buy and hold, or some variation on the theme. And what we found was that, really they had no sort of exit plan. There was no hedging. There was no risk management. They basically just held your hand and said, don't worry, it'll come back. Now, it's taken, quite a number of years, 5 or so years to come back, and a lot of them either didn't have what we call, the stomach or the ulcer index. They weren't able to really stomach it, and some of them panicked and got out and really never got back in, and so really never had that whole upride last year. And others, some of them did hold on and it did come back. But if you look back through time, there's been so many instances in time where things did not always come back where they should be. And so we just really believe that it's very important not just to diversify across asset classes, but also to diversify across strategies. And it's very hard, I think, for the average person who's not an ultra-high net worth individual to really have access to that type of strategy as well as asset diversification. And so that is really our mission for PJMINT, is to really give access to and democratize these types of strategies, what we call the investment pod. and that P stands for the passive buy and hold piece that a lot of people believe in and already have, and there's nothing wrong with it. But we also give people the opportunity to add in what we call O, which is the opportunistic piece, which is more from our background of, the hedge fund background, which is a more tactical solution. And then the D, which is a defensive risk management piece. And we think that the three strategies together, core strategies together, what we call the pod, really is a comprehensive solution that allows, whether you're a DIY investor or a wealth manager who's maybe specializes in stock picking, to build a suite of strategies for your clients or for yourself, and it allows you the greatest chance of success because you've got different strategies doing different things at different times.
So are you strictly quantitative? I mean, you come up with these strategies to analyze the markets, you put in your inputs, and then read your signals, or do you have any kind of discretion in your trading style?
No, actually, this firm was founded together with my husband, Dr. Peter Matthews, who's a PhD. He actually is very well known in the hedge fund world. He was one of the sort of pioneers and founded one of the largest global macro hedge funds in the world. And they had been the first to sort of break the billion-dollar barrier. He was profiled in the book Market Wizards. He was, really had received a Lifetime Achievement Award for really bringing sort of alternative investments into the mainstream asset class that's been accepted by endowments and pension funds and so forth. So he's really the creator of the systems that we call the investment pod. And what we have that's really unique is an experience for investors to go online. They can create their own account at pjmint.com, and we have what you call an investment simulator. So you can basically, we have three core strategies, but within the P, the O, and the D, we have three sub-strategies, and so we have a total of 9 strategies. And it allows you to sort of mix and match among the 9 strategies and run backtests with real-time data. And it basically shows you what we call the Ulcer Index, which is a mathematical measure of the depth and duration of drawdowns. And it lets you feel like, okay, in 2008, would I have been okay with this type of drawdown? It shows you all the numbers, the returns, the volatility, and so forth. And it allows you to say, okay, no, I think my client or myself, if I'm a DIY investor, I think I want something a little more aggressive, or I want something a little bit more conservative. I need to maybe add a little more risk management in it. And then when you're satisfied with your plan, you can make as many as you want. You can have as many accounts as you want, and it's all in one dashboard. You click activate, and our trading and execution team basically takes care of everything. It's in your own account, and it's basically it's fully transparent because you can see everything that's going on. You can choose your broker. Right now we're working with Schwab and Interactive Brokers. And I think the important thing is that you're not paying multiple layers of fees. There's no wrap fees. There's no high mutual fund fees. We use all ETFs, so very low cost, highly liquid ETFs. And you get that diversification across asset classes as well as strategies. You get control over your money because everything stays in your own name, in your own account. And so I think those are really important features, and of course liquidity, which a lot of people don't believe. I believe a lot of people don't place enough premium on liquidity. Of course, they try to get strategy diversification. Some people do private equity, some people do real estate, but those are not liquid assets. And when you have family emergencies or things where you need the cash and you can't get it, or you got to sell it at 10 cents on the dollar, that kind of eats up all the upside that you're hoping to get.
Okay, so the technology that you used was all created by your husband, correct? As far as
and our team, that's correct. But
okay,
mostly our husband is proprietary. Yeah.
proprietary, and then as far as like the platforms that you use to run it, that's all proprietary too. And as far as people having their accounts, they can keep it with their individual brokers. What do you need to open up an account with PJ Mint? Is there a minimum?
Our minimums are very low. It's only $5,000, but we really recommend that a good amount to start with is probably somewhere in the $50,000 to $100,000 range. That would be our recommended amount. 100 would be kind of the sweet spot to start at. But really, we try to keep it low because we're really trying to democratize it and get as many people have access to it with the market that's really underserved by sort of the traditional bricks and mortar wealth planners who really don't service you unless you have, some have $5 million minimums, some people have $1 or $2 million minimums. We're really trying to get this to as many people who really need it.
And how long have you been running the strategies?
So we started with institutional clients probably about 16 or 17 months now.
Okay. Okay, and you feel with this kind of POD strategy here. I mean, obviously, you know, anybody who's been managing money may look pretty good over the last couple years. If there's like a sudden downturn in the market or a major correction, do your
hmm
models, shift more into a defensive cash mode, or do you participate in the downside at all? Perhaps getting your clients into something like a that reflects ETFs like the SDS that will rally when the market is inversely related to the market.
hmm That's a great question. So yes, well, we don't short, but we do participate in some inverse ETFs. But I think risk management is really what we're all about. The key is all about respecting risk. And so, if the clients do choose the defensive risk management piece as a piece of the overall portfolio, then yes, of course, those strategies would move you out into cash and basically let you know when the right time to get back in is. I mean, obviously, we would be doing all that. You're informed of it, but you don't have to actually do anything. It's not a DIY service. But it's really trying to save you from that big, that big downward move and that big ulcer index. So it is moving you out into cash and then back in when the time is right. The opportunistic strategy is really, to step back, the defensive strategy, so you're not invested all the time. Like I said, you move out into cash and then back in when the time is right. On the opportunistic strategy, it's a bit more aggressive strategy where we're really trying to capture, we believe there's always a bull trend somewhere globally in the markets. And so since we cover global ETFs across all sectors, we're really trying to look for where the bull market is at any point in time. And so we're always trying to pick the winners and get out of the losers. And so you're fully invested, your money is fully invested at all times. And we're really trying to pick that to see where that momentum is.
Okay, so you don't have an opinion on the market. Your opinion on the market is your models, correct? And that's what you follow. So, it's
Yeah, we don't believe in the prediction game. We just believe that again, this is probably a little bit unpopular belief, but we just don't really believe that any one person can really predict with any point of accuracy based on our scientific research. Sometimes you might get it right, but it's hard to get it right over a long period of time. And what we're trying to do is really provide a very robust, comprehensive, long-term investment management solution that can basically weather the storms through all types of environments. We don't really care whether the market is going up or it's going down. It's really all about risk management because that is really the only thing that you can control in life. The rest of the outcomes, it's very hard to control. And some people may say they're great at predicting this move or that move, but based on our scientific research and our PhDs and stuff, we don't believe in that theory.
And so technical analysis really doesn't play. Does that play a role in any of your models?
Can you be more specific on what you mean by
Charts,
technical analysis?
charts, technical analysis, looking at the charts patterns over.
Obviously we don't do any fundamental analysis, but obviously, we do look at historical patterns but we look at them for long periods of time, going back 40 years, sometimes back to the Great Depression. But we really believe that the financial markets are an example of what scientists call our complex adaptive systems. And what that means is that, we are all made up of, the financial markets are really made up of a lot of humans around the world you, me, and all the people out there, and we could hear a piece of news come on at CNBC or wherever, and you may buy and I may sell, and people around the world are all doing different things based on that same information. And the reason why we believe that the traditional sort of modern portfolio theory, passive buy and hold approach, really hasn't been updated since the 1950s when it first came out. We really believe that that approach on a standalone basis is dangerous because, that was really done in an era where there was no internet. Stocks and bonds were, you could, say that they have inverse relationships. That if you're invested in China and you invest or internationally, or you're invested in the U.S., that they have negative correlation. But that's no longer true in a world where we're very connected through technology, and it's very highly likely that the U.S. and the international markets could go in the same direction, and stocks and bonds could go in the same direction. And so, just the asset diversification alone doesn't give you enough diversification of negative correlation anymore, and that's why we believe you need to have strategies to at least statistically increase your chances of having a better outcome.
Okay, we've had Jackie Matthews on, founder and CEO of PJMINT, taking a quantitative approach to the markets. Also, I think interesting that you can do it with a low investment. Jackie, thanks a lot for coming on. It's very interesting to hear your perspective on the markets, and we hope to have you on again.
Thanks very much. I enjoyed it.
Okay, Jackie Matthews.
All right. Bye-bye.
Bye bye.